I think this move in gold prices and in the gold equities, and now the silver equities and the other precious metals equities, and then seeing what they're doing with their money and seeing the change in perception as they go and issue shares to go drill more and expand mines and so on, which we're starting to see. We're starting to see that on copper too. I think it's very interesting and very educational and very promising, almost more so, I think, as an oil and gas equity investor than the move in the equity prices from the COVID lows in 2020 to the post Russia invasion in Ukraine highs in mid 2022. I think it's actually the fundamental case. I think the analog is better looking at these gold miners recently and this change in perception and change in investability and real true re-rating and valuations and sort of overall approach to the sector, very different and very promising versus what we saw.
Hey everyone, my name is Anthony Fatsis and welcome to another episode of the What the Finance podcast. On this podcast, I have the pleasure of welcoming on Josh Young. Josh is a contrarian investor and specifically focuses on the energy markets, CIO of Bison Interests and author of Bison Insights. So Josh, thanks so much for coming on the podcast.
Yeah, thank you. Thank you for having me.
No problem. Looking forward to the conversation. It's been a really interesting year for energy, and it's been, quite a lot of divergence. I'll be really interested in hearing, what are your thoughts on 2025 and what we've seen?
Yeah, sure. So I think there's been some surprises. I think the biggest is that there have been a few different sort of potential geopolitical events that could have led to material oil supply disruptions. And historically, you've seen somewhere between 2 and 5 million barrels a day of supply offline because of those sorts of disruptions, whether it's civil war in Libya or sanctions on Iran or issues with Russia or so on. And I think we got to a record low level this year in terms of disrupted oil supplies. And I was expecting supplies to be more disrupted, partly because of the war with Russia and Ukraine, partly because of the war that sort of culminated with Iran, between Israel and Iran in June of this year. And I was wrong on that. And so far there's actually been fewer disruptions, not more. And so that's actually contributed almost entirely. If you look at the net oil surplus in 2025, the net surplus has been about 1 million barrels a day on average. It's been weighted to this back half of the year. And so that's, I think, actually been the biggest surprise.
Okay. And you think that's the main driver of potentially, why oil has come down? Because I think it's come down, more than $20 this year.
Yeah, well, I think it's sort of the biggest surprise. I think the other sort of couple of interesting things are, one, I thought that OPEC Plus would have brought on production a little more slowly, and they saw higher than consensus demand this summer, and so they responded to that by bringing on the production more quickly, even with Trump's tariff war and various other issues that impacted demand. They were right that demand was still higher than people thought. And I think they may have miscalculated in terms of sanctions enforcement, sort of similar to what we saw in 2018, where we saw Trump promise sanctions enforcement to the Saudis of Iran and then not follow through. You saw oil prices crash in the second half of 2018, and then you saw significant sanctions enforcement and supplies from Iran dry up in 2019. And so I think we're sort of in a similar situation. And I'm not sure if the Trump administration this time around will actually follow through on their commitments, but it would be surprising if there wasn't some sort of quid pro quo to get some of this additional production on. So again, more OPEC production on, fewer supply disruptions, fewer sanctions enforcement. And then I guess the one additional surprise is just how much more production we saw here in the US in particular on the natural gas liquids side, despite the declining rig count. And I think we're sort of at the peak of that. And I think well productivity declines are kicking in enough, along with rig activity levels falling enough that we should see production actually roll over here in the US, but we haven't seen it yet, at least in the observable data. And so, I guess that's sort of three reasons. And I guess in the context of all three of those sort of going the bearish direction, it is pretty impressive that oil fell by only, let's say, $20 a barrel and not 40 or more. So, it's not a great price for the industry, but it is, I think, pretty impressive, the resilience that the prices have shown through the year, despite sort of these multiple headwinds.
Yeah, really interesting. It was interesting what OPEC did, and there was a talk that they wanted to sort of focus on market share potentially, because there's been lots of non-OPEC supply coming online, as you said, in the US and other parts of the world, and it seems like that's going to continue potentially in the first half of next year, from what I'm hearing. And then after the first half of next year, there's going to be less non-OPEC supply coming online, which hopefully then means that there's a bit of a rebound in oil. Is that sort of what you're seeing as well?
Yeah, I mean, we'll see. I'm not sure how much more non-OPEC supply is going to come on, how much incremental supply. Everyone always focuses on the one or two countries that are growing, and they ignore the many, many countries that are shrinking. And so I think in aggregate, it's going to be pretty hard, especially from current levels, for non-OPEC supply to grow materially in 2026. And you do have a few projects, I think, that you were alluding to in early 26. So maybe those still contribute to production, but there's still a lot of risk on other projects that have either been delayed or are starting to go into decline. And so I think it's a real question mark in terms of how big of a glut there may be in 2026. And then in terms of OPEC, one of the really interesting things I think sort of everyone missed, you referred before to a market share war. I'm not sure that's how they see it at all. And I think they were setting up essentially, one, they thought that there would be more demand and less supply than ended up in the market this year. So I think they were sort of caught off guard. They're using some of these industry consultants that, no one's perfect in terms of their assessments of the oil market or their predictions. And, those guys were wrong. The consensus views were wrong. And so they were sort of off on that. And I think I think it's most likely that they end up sort of recalibrating using what they did this year, which was basically pull off almost entirely the production quotas. And you can tell that because almost none of the OPEC plus members are actually producing in line with their quotas. There's a sort of increasing gap between their current production and their quota levels, where it used to be that they would be cheating and producing in excess, and now actually many of these countries are producing under. And as the quotas have gone up, they've actually not been able to catch up. I think there's an increasing chance that they use what they did this year to recalibrate and then cut with sort of recalibrated quotas at some point in 2026, absent a material price rebound. So I think it's not a market share war almost at all. I think they were just sort of offsides a little bit in terms of their market expectations, and then also using this as an opportunity, again, to sort of deal with some of the internal stuff, as well as to be able to be more forceful and more impactful the next time that they do cut supply from the market.
Yeah, interesting. And as you're saying, I think a lot as well, there was countries like Kazakhstan that would cheat, that were sort of overproducing. I'm not sure if you think that's correct, but they were overproducing their sort of quota. And I think there were a few areas like Iraq. And now this is just a way, even though they're increasing the quota, it actually hasn't increased much production.
Yeah, well, it's sort of funny, I think, with a few of those countries where they were cheating, and they were cheating for sort of discrete reasons. So Iraq has an issue with the Kurdish area, which is quasi-independent, and I'm sure people will get real mad for how I characterize that. But they have a separate deal on their oil production, and so I think there were some internal motivations in Iraq to get some of that overproduction, and then there's also some rumors that some of that may have been smuggled Iranian oil that was getting sold through Iraq, and then or at least marked as being produced from Iraq. And then Kazakhstan, they had these giant expansions that were very expensive, that were funded. I think the biggest one was funded by Chevron, and so it was a little awkward for them to try to not produce that. And I think there might have been some contractual issues with Chevron, and frankly, some issues in terms of Kazakhstan's relationship with the US government if they had tried to impact that. And so I think I think what you're seeing here is you saw OPEC expand Kazakhstan's quota, but now that project's on, and there were sort of broad declines in Kazakhstan outside of that particular expansion. And so now the expansion, it looks like, is in decline, and there's base declines, and there's issues with this CPC sort of pipeline and export system that Kazakhstan is selling their oil through. And so the combination of those is actually leading to Kazakhstan now missing their expanded quotas. And even as CPC comes back on, it seems more likely, and you're seeing sort of a growing consensus in the industry that that they're actually going to not be meeting these expanded quotas, and that they're actually going to go into decline. And then similar actually with Brazil, where they showed a lot of production. There were a number of projects that were delayed by months or years that many came on. There were many FPSOs, so floating production units that came on that allowed offshore projects to actually come into production. Well, now they're in production. Again, Brazil's not, I guess they're sort of now a visitor for OPEC. And it's going to be sort of funny. I think you could actually see Brazil join OPEC as they go into decline, because the number of new projects they're adding is falling a lot. And then a number of the existing projects they've brought on have actually, some of them are actually already in decline. And so, I think when you look at it carefully, both OPEC and non-OPEC, a lot of the contributors to additional production in 2025 may actually be places that end up plateauing or even going into decline in 2026. So that's where I'd be real careful on sort of looking for those production adds and trying to understand, Brazil missed their production forecasts basically every year for a decade. They call it like a porcupine chart, where you'd see what the guided production was and what the actual production was over and over again. And so my general bet has been, hey, they'll miss. And so I was wrong this year, but I've been right on that every other year for the last decade. And so I think 2026 is going to be another year, for example, where Brazil misses on their guidance. And then, similar for the oil majors, where, Exxon has missed on their guidance over and over again. People are real excited about Exxon, whether it's in West Texas or Guyana or various other places. And similar idea, where I think there's just occasionally you'll have a year or a streak where you'll end up with some of these underperformers or laggards coming in and actually delivering, or in some cases actually outperforming. But I think that's sort of an aberration, and we saw a lot of that in 2025, and we're starting to see signs, I think, that actually we'll see less of that or see some declines, again, both in those OPEC countries like Kazakhstan, where I think they're going to have some embarrassment, and then Iraq, where they're having some issues. They're technically allowing, it looks like, production again from the Kurdish areas, and yet their production's coming off a little, which again is sort of counterintuitive and shows, I think, that there were some political aspects to what was going on, rather than sort of that being indicative of their likely future supply on a multi-year basis. And then again, Brazil, and then looking at some of these oil majors that have grown a lot and are forecasting growth into the future, but have terrible records historically of actually achieving that growth.
Yeah, it's really interesting. It's a lot of what people don't realize is the depletion. I guess the IEA released that article this year where I can't remember how much it was, but hundreds of billions of dollars needed invested every year just to keep sort of oil production stable, yet alone to grow with demand needed.
Yeah, I mean, the IEA is amazing. They've been wrong apparently 17 years in a row on forecasting oil demand, and then the banks, most of them use the IEA as their input for their forecasts for oil prices and for their commodity balances. And I just don't understand it. I don't know if it's some like weird sort of backroom political thing, maybe because some of these banks got bailed out in 2008, and so they have some government affiliations or obligations. But it's sort of strange to be that wrong. I mean, people give me a hard time. I've been bullish oil for the last, I don't know, what is it, 10 years since we launched Bison. And, it's been great in terms of the specific stocks we've been buying and stuff. It's not been a great time to be overall an oil and gas investor. And, we've done really well, and yet in the last couple of years we've been wrong. And so it's like, get tons of flack for being wrong for a couple of years, and here the IEA is getting tens of millions a year in government funding, maybe more than that, to be wrong over and over and over again. So I think there's almost no chance that they're forecasting something like a 4 million barrel a day oil oversupply for 2026. And I am betting very heavily against that, and I see almost no chance of getting anywhere close to that.
Completely agree there. as you say, always wrong, basically. So if we go to the US, you mentioned Exxon, and there's obviously a lot of other big players, especially, if we look at shale, normally it has a higher break even than, I guess, the deep water production. So how do you see them reacting versus prior market downturns? Because it does seem like, from what I'm seeing, they have sort of better position balance sheets. They're potentially willing to run a bit longer than previously. As you said, there's this focus. Not many rigs have come online. There's sort of a focus of efficiencies that we've seen with Exxon. Saying they're increasing their efficiency by 20% by putting using this new technology and increasing the lifespan of these shale as well. So how do you see that impacting, I guess, this current cycle and them actually taking the rigs offline?
Yeah. So when you look at the history of shale and you look at oil prices since the advent of the rapid production growth from shale in the U.S., let's say starting in 2010, 2012, when you see these big oil price downturns, yeah, there was an OPEC price war in 2014 and 2020. And yeah, COVID was terrible. And there was some weird stuff with the Saudis and Iran in 2018. But almost all of the oil price declines have been explained by one, the addition of new fields, and then two, the dramatic improvement in well productivity on a per foot basis. And so, um, what you'll notice when you look at US shale is there haven't really been new fields of scale since the Delaware Basin really started to come on in 2016. And really, that sort of the peak growth there was in 2018, and that sort of crashed the market along with the Iranian sanctions not being enforced by the Trump administration, the first Trump administration, up until the end of that year. And so what you don't see is the next Delaware Basin. It just doesn't exist. I mean, you have the Montney, you have the oily Utica, you have the Uinta Basin, you have these various other places that are comparatively quite small, or in the Montney case, Canada is quite pipeline constrained and has its own sort of set of challenges, has some issues with in British Columbia with property rights and various other challenges. And so you just aren't seeing that same sort of new discovery category that pushes down price and historically has explained a lot of historical oil price cycles. And then when you look at it on a per foot well productivity basis, well productivity for oil and natural gas in the US peaked around 2020 or 2021 on a per foot basis. And so what we've been doing as an industry is since then just going with longer and longer laterals. And then somewhat recently in the US, I think it was Shell that pioneered this, which is actually pretty cool that an oil major was able to figure this out. And it was sort of its own whole topic of conversation, but they figured out how to do these U-turn wells where if you normally just drill one, let's say 2 mile lateral, you drill down a mile or two to get to your target zone, and then you drill 2 miles across and you fracture, stimulate the rock across those 2 miles. They figured out how to do that 2 miles and then turn around still underground, your mile or two down, and then drill 2 miles the other direction and complete all 4 miles of that lateral. And so that's been a big innovation and sort of this big step change in terms of opening up additional economic locations. But we're getting to the limits of that too. And so again, just to summarize that, basically there aren't new discoveries that are material anymore in US shale and also pretty much Canadian shale. And then the well productivity improvements that we saw, one that were driving per foot well productivity, have come off, and we're actually seeing per foot declines. And then we're actually seeing the second derivative has gone very negative on well productivity improvements, even by adding additional lateral feet. And so I think we're about to go into just overall decline on shale production on a per well basis and a per rig basis. And I think that's the point where you're going to start to see oil prices go up a lot, because you get into this, they call it like a Red Queen effect, where basically it was like in the US in the 1970s where they'd add rigs, but adding rigs didn't actually add production because the decline rates were so high. And so that's sort of the thing I think to watch out for in shale that would get me even more bullish And it looks like, again, that second derivative has gone very negative. So the rate of change of improvement from going longer has fallen, and you're actually getting less good as you go longer and as you go to those U-turn shaped wells. And then you know, at some point that should drive your well productivity actually going quite negative. And once you go negative in well productivity, you have to start adding more rigs. As you have to add more rigs, you're going to start having to go to worse and worse locations. And you can get into that same sort of dynamic that we saw in the US in the 1970s. And I think that's where, one, you get a lot of rigs going to work and a lot of employment. And it actually would be quite good for the US economy. You'd see higher commodity prices, but a fantastic economic boom in various places that have oil and gas shale resources. But you'd also see much higher prices because adding more rigs wouldn't solve the problem. It probably would also drive additional offshore activity, but the cycle times offshore are 5 to 10 years versus, especially for new fields, closer to 10 years versus, shale where you can add a rig and start adding production within 6 months.
Yeah, really interesting. So I know a lot of people saying, they're seeing peak Permian and potentially peak shale coming in the next few years, potentially even, now, even though, Chevron and Exxon seem to think that that's potentially further on. They can continue to grow their shale production. Yeah, what are your thoughts on that?
Yeah, it's a great question. I don't think we're at peak. I just think I think the break even costs are rising, and it's been interesting because the number of rigs active is falling, and then the number of lateral feet drilled is finally actually falling. So even as you drill longer laterals and get more efficient with the rigs, the equivalent number of feet that you're sort of fracturing, you're drilling, fracturing, and getting production exposure to is starting to fall. And so even with that, as the operators, as the E&Ps get more and more careful about which locations they're drilling, they're suffering from core exhaustion where they're having to go to worse and worse locations. And again, the benefits of these longer laterals and more stages and U-turn or whatever type wells that's starting to diminish. So I'm not sure that we're going to get to a peak anytime soon, in the sense that I think there's a lot more production to come from shale at much higher prices with many, many more rigs. I just think we're pretty far from that. We've been going to fewer and fewer rigs and really trying to eke out those incremental productivity gains. And I think what you'll see is that sort of Red Queen effect I described for a while, as you try to add rigs and try to add production eventually. And after that, I think you will actually see significant production growth again. It'll just be way less productive wells. There's hundreds of thousands of locations that are sort of tier 2 or tier 3 type locations that, maybe in the first year you might produce 100,000 barrels a day of oil rather than 300,000 barrels a day of oil. And so again, you just need much higher prices in order to induce that. But there's a lot of oil still out there. So I don't think we're at or near peak production, but we might be at or near peak production on the oil side at 55 or 60 or even $65 oil.
Yeah, great point. As you say, there's lots of oil out there. It's just about the economics and whether it's worth getting out of the ground. So the trend we've seen this year is that we've mentioned that commodities come down quite a bit, but a lot of the equities have actually sort of stayed pretty resilient and had very great performance, at least up until the last few days, specifically in the big IOCs. So, what do you think has been the difference between this and prior cycles, and why do you think that's happened?
Yeah, well, I think the starting point for these valuations was really, really low. I think, just for context, if you look at how these different indexes had done over time. So we were looking at this just to benchmark our own sort of fund performance and just try to understand sort of like where we're at, as well as looking at a little bit. We put out a thought piece for the investment firm a few months ago, looking at the performance of gold miners and trying to understand where we're at in the oil cycle and what could happen with smaller cap oil and gas stocks in the context of these gold miners. And hey, maybe we're going to see this happen next for oil and gas. Oil and gas small cap stocks, the index is down about 70% in the last decade, and then the index for larger cap oil and gas stocks is down by memory, and these are a little old. It's actually probably down more now, like you said, in the last week or so since we spoke, or since these indexes are down a lot more. But even the large caps are down, I think, like 30% in the last decade, and the oil majors, I think, are up very slightly. But this is a decade where the S&P 500 is up close to 200%, and then now gold miners, which actually had been down for most of that last 10 years, now in the last 2 years have caught up and exceeded. I think they're up something. We were looking at the junior gold mine index, GDXJ, that ETF, and it's up close to something like 300% in the last decade. And so I think what you could see is material outperformance, especially by the smaller caps, which are more dynamic, more able to respond to price signals, more able to adapt and adopt new technologies and drilling techniques and pursue new fields and so on. And you've seen that historically where they go from worst performers to best performers in past cycles. And so I think you could see them go from down 70% in the last 10 or 11 years to up several 100%. And so I don't think it's that weird of an aberration to see them outperform oil or oil and gas prices over a shorter time frame, just because I think there's sort of this overdue outperformance over a longer term time frame. And so a similar way to think about that would be, hey, gold doubled and the gold miners sort of, I don't know, 5x or something like that. And so I think people are starting to understand that a little bit. And the sort of most forward looking, most value oriented, longest term investors are starting to buy oil and gas stocks, looking at what's happened in some of these other commodities. I think that's what's happening. And I think it's sort of rational if you look at that, because there's so much potential in terms of the returns for these producers and services companies, to the extent that this time isn't different. And generally speaking, with cyclicals and commodities, you've had a way higher hit rate betting on this time not being different rather than betting on this time being different.
Yeah, great point. And I think similar to the gold miners, oil companies have generally been very poor allocators of capital, but it does seem like that's sort of shifted over the past couple of years, and there's been a major focus on higher returns versus growth, as was previously occurred.
Yeah, although the ironic thing is, and actually one of the things that's getting me so excited about oil demand over the next year or so, maybe a couple of years, is that a lot of those companies that now everyone hated them, they thought they were complete idiots or worse, they're now issuing shares to go expand their mines or buy additional companies, buy additional mines, drill new holes, all of which, other than the just buying other companies, is very oil intensive. And so the perception of these industries as good or bad allocators of capital, places where capital goes to die or thrive, those perceptions are also cyclical. And I think it's helpful to keep that in mind and to sort of look at the longer history of these things and not get too sucked into the particular sort of day-to-day or year-to-year sort of narratives and trends and so on. And so I think this move in gold prices and in the gold equities, and now the silver equities and the other precious metals equities, and then seeing what they're doing with their money and seeing the change in perception as they go and issue shares to go drill more and expand mines and so on, which we're starting to see. We're starting to see that on copper too. I think it's very interesting and very educational and very promising, almost more so, I think, as an oil and gas equity investor than the move in the equity prices from the COVID lows in 2020 to the post Russia invasion in Ukraine highs in mid 2022. I think it's actually the fundamental case. I think the analog is better looking at these gold miners recently, and this change in perception and change in investability and real true re-rating and valuations and sort of overall approach to the sector, very different and very promising versus what we saw even with that sort of like mini cycle for oil and gas in 2020 to 22.
Yeah, really interesting. I think a real trend at the moment as well is natural gas, and we've seen be very volatile in the US. It's sort of went up massively. So how are you judging that market? Because I think as well, it's interesting. We're seeing US natural gas coming up and sort of global LNG and gas prices coming down as well. So what do you see?
Yeah, I think it's a good question. I think I'm much more bullish on the oil producers than the gas producers. I think natural gas, more people are bullish, and I think that's just intrinsically less comfortable for me to bet on. Um, as I guess a contrarian, but also just understanding the nature of these commodity cycles, where high prices lead to low prices and low prices lead to high prices. I do think that we'll get a little bit more movement in natural gas. I think we got to over $5 very briefly on the spot price for gas. We're now down closer to four. I think that the forward curve is down closer to four. I think we'll get closer to, let's say, a $5 sort of mid-cycle price for natural gas. So there's some upside, and there is some upside in the producers. But that's nothing compared to where I see the upside for oil. And I think that the big difference is, where I was referencing this sort of tier two rock for oil shale versus the, look at like the tier two rock for gas shale, where there's a similar sort of dynamic. And, we're much closer to that tier two rock for gas being highly economic, whereas oil prices could double and you may or may not make full cycle profits by going and drilling a tier three or tier four oil shale, some of the inventory that's just not getting touched at all right now. And so I know that might sound radical, but again, you just look at, there was a industry consultant that put out a report recently that cited 37,000 locations remaining in the North Dakota Bakken. And if you look at probably 35,000 out of those probably don't make any money under $100 oil in terms of full cycle actual, like, hitting a 20% return threshold, which would be necessary to pay for G&A and various other sort of cost of capital questions. And realistically, a lot of those probably require much, much higher prices. Whereas on the gas side, a lot of this sort of tier two, tier three inventory makes quite a bit of money at sort of $5 gas. So the demand is there in terms of LNG export facilities getting built at a very rapid pace. There's a lot of demand globally for LNG as you get towards the LNG prices we're seeing right now in Europe and elsewhere. And so there's really quite a bit of demand creation through that recent decline in international LNG prices. And so that's, I think, the big driver. And then the data center boom is fantastic. It's helping debottleneck some gas in some basins where there just hasn't been enough pipeline development. But it's a lot smaller, and it's taken, I think, a lot longer than people expected for demand to come in. But it's real and it's big and it's coming. But I think the LNG boom is even bigger and it's great, and I think it could keep natural gas prices towards that mid-cycle price of, let's say, $5. It's just there's way less upside, I think, on the gas side than there is on the oil side.
Yeah, similar to oil. Well, maybe not similar, but there seems to be more of an obvious glut in natural gas and LNG specifically versus oil. Um, but yeah, so you're obviously looking at very specific. You're looking at specific companies. So what do you look for when you're sort of looking to invest in a company in this industry?
Um, Yeah, so it's been it's been a wild last decade. I mean, we launched Bison in 2015. We thought oil prices would rebound in a few years, and that buying companies at really depressed prices versus where they were in the prior cycle would lead to excess returns. We were right on the excess returns versus other oil and gas companies, but we were very wrong in terms of where the sector would go. Um, so we launched Bison. That the concept was to invest in companies that sort of had four characteristics. We wanted good management teams measured by value creation over current and past companies. We wanted companies with survivable balance sheets that could survive through commodity down cycles. And we wanted assets that were potentially substantially cash generative that also various other companies would want to buy potentially. And then we wanted all of that at heavily discounted prices versus sort of conventional cash flow metrics, as well as through our assessment of sale value, liquidation value, and replacement cost.
Okay, yeah, great. And it's mainly focused on the US, or so are you looking globally as well?
Yeah, we look all over. When we launched, we were doing mostly U.S. and a little bit of Canada. I ended up as chairman of the board of a Canadian publicly traded E&P in 2017, and we sold that in 2018. And as a part of that, I got to, I think, understand the Canadian market a little bit better than I had, and it was a quite out of favor area in that time frame. Alberta had been it was getting run by the NDP party, which from a U.S. perspective, it's sort of the equivalent to like the American Socialists, as sort of as like further to left than the Democrat Party here. And so it was very, very out of favor, and so tilted more heavily towards Canada. And at this point, we have some U.S. exposure, some Canadian exposure, and then a little bit of exposure to various other jurisdictions. Generally, my preference there is to find on an international companies outside the US and Canada, companies that are ultra cheap and also are in jurisdictions that it looks like have a good chance to go from to do something similar to what happened in Alberta, where it's run by governments that are very averse to the oil and gas industry and frankly averse to business broadly, and where there is a path towards improvement from a governance perspective, from the perspective of the oil and gas industry, and from the perspective of public equity investors. And so, looking for deregulation, lower taxes, and just sort of a more friendly political environment. And so, we've actually done pretty well on those sort of international bets and have some exposure in a few different jurisdictions right now that I don't know if all of them are going to work out great, but a few of them are looking really promising right now.
Yeah, great. So, Josh, thanks so much for coming on. We've really appreciated sort of we've gone over the globe and different commodities. But my last question is, what is one message you want people to take away from our conversation?
Sure. I think it's really easy to get sort of wrapped up in these sort of short-term narratives, or to look at what's happened over a 1 or 2 year period and say, hey, I will sort of straight line this into the future. And I think when you look back at what's happened in past commodity cycles and past oil and gas cycles, as well as what's happened with the equities through those cycles, I think it looks way more exciting, way more promising. And so I'm really excited. I love investing in these companies. I'm really happy to own them, even on days as we're talking, oil and gas stocks were down 3 or 4% on an index level. So, some of the individual names were down a lot more. And it's always nerve wracking, but also exciting to get to buy more of them on days like today. So I appreciate getting to come on here and getting a chat with you and your listeners. And thank you very much.
Yeah, great. Thanks so much for coming on. Appreciate it, and looking forward to doing it again in the future. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Sure. So we have two things. So I'm the chief investment officer for Bison Interests, which is an investment firm, like we were talking about, that invests in publicly traded oil and gas companies. And then I launched a newsletter recently called Bison Insights, and so that's sort of more broad focused, not just for accredited investors, and it's actually gotten a lot of traction, which is pretty fun and sort of surprising. And so if you want to check that out, bisoninsights.info is where to go to check that out, and happy to have anyone check it out.
Yeah, great. I'll put it all in the description below, but thanks again for your time.
Thank you.